Hey, Stephen McManus here with Coastal Collective Group, here today with Derek Goulette to talk to you about the lending process.
Hey, Stephen, thanks for having me out. Really appreciate it. As we were chatting about before we started rolling, everyone wants to get a home, but not everyone wants to get a home loan. So we're here today to maybe bust a few of these myths and just talk about the process.
So, Derek, tell me a little bit about yourself and what you do.
So Derek Goulette with Fairway Independent Mortgage. I may look young. I've actually been doing this for 25 years in the family business. And I love helping people navigate the waters of buying a home, because the home loan can seem like the scary part, but we try to take some of the nerves and ease into that process.
So what are some scenarios or buying situations that a buyer that you would recommend coming to you for specifically? What is your expertise, or you cover a gamut of different scenarios?
I mean, we do it all. When you've been around this long, you've seen everything. But I think that there's a myth out there that not everyone can buy. And so if we look back at some of the successful transactions we've done, it's people who didn't think they could buy, whether it's that veteran buyer, the first time buyer who's renting, who doesn't, have a down payment. And sometimes it's simple as a conversation and just teasing a few things out of them through that learning process of what's important to them, what's their budget, and then does their budget line up with what they are currently in, or can it exceed that figure? And sometimes it's one or the other, but that helps us lay the groundwork for making that person a successful homeowner, whether it's their first time, their 10th time, or their 25th investment property.
I was just thinking while you were talking about how the emphasis that we put on new home buyers and all the help we give new home buyers, but we expect people who have bought a home to be a pro going into their second or their third home. And those types of buyers need almost just as much hand-holding to relearn the process and know what's possible still. Because you're out of the game for so long when you own a home, you don't even know if, what interest rates are doing, how that's gonna impact your payment. Maybe your job changed, so you have, your 1099 now, or you're self-employed, you're not W-2 anymore.
There's so many variables. And if you think about it, historically, the average homeowner lives in their home for about 8 years. Now, the last couple of years have been different. But at 8 years, you have forgotten all the steps involved with buying a house and getting a home loan to buy a house. Unless you're paying cash, which, we love those people. They're fantastic for the economy, for all that. But when it comes to getting a home loan, a lot changes every couple of years. And so dealing with somebody or working with somebody who is in the trenches day in and day out, helping you navigate these waters is monumentally important. So think about something you did 8 years ago. Do you remember what that's like to do it today?
No.
Unless it's riding a bike or driving a car.
If there's a need to buy a home, or if you want to move, if you're making more money and you need more space, or whatever the reason is, and it's just an idea, start talking to a lender now. This isn't an advertisement. This is what I see every single time I talk to a buyer is, have you talked to a lender yet? That really, you want to contact an agent for sure to start understanding the market and what's out there. But talking with a lender is extremely important, because a lender will take this mess and put it in their funnel, if you get a good lender like Derek, and simplify the process for you and make it very easy to understand. It's like people rent, right? They're like, forget this lending stuff. I'm just going to go rent something. But putting all that together, and especially with your side-by-side comparison, maybe you want to talk about that.
Yeah, we have a bunch of tools that we get to use that help simplify and demystify what somebody is looking at from a payment perspective. We get to do these side-by-side comparisons that walk them through how much they're paying in rent, how much they would pay for mortgage A, mortgage B, mortgage C, what their cash to close is to get there. And that really takes the guessing game out of what does it really look like if I were to buy a house.
Making the options that you have as well, right?
Correct. Making the complex as simple as you can.
And the option A, B, and C, maybe you talk a little bit about what that.
Yeah, it all depends on the borrower or the client is maybe a better way to say that. But option A might be an FHA loan with a minimal down. Option B might be a conventional loan with a little bit more down. And option C might be, what does it look like if you saved up 20, 25, 30% and put that down? And then you just compare and contrast the payments versus how much cash you're putting out of your pocket. And let them make an educated decision for themselves. Yep. But again, it goes back to simplifying that process so that somebody doesn't get overwhelmed. Because again, there's oftentimes we have conversations with people when, they think they can afford to finance a cardboard box and they can actually buy a $600,000 house.
And so, for instance, Derek will meet with you, talk with you about your situation, go through your options verbally, and then send you a follow-up video of him explaining what you talked about together. Plus, in that link will be a side-by-side, potentially by-side, comparison of all the different options that you have if you're, again, FHA, conventional, or VA if you're, military. And you can see what all of that looks like from a monthly payment perspective, cash to close, all of that. And that'll include a lot of your escrow projections as well, correct?
Correct, yes.
So again, if you don't know what escrow is, it's your insurance and your taxes that are paid throughout the year in your monthly payment. You still only have one monthly payment if you have a mortgage. So it's the same thing as renting. It's just that there's a lot of different moving parts leading up to that initial payment. And again, if you have the right team, we handle all of that. And some people don't believe that. Some people, because before I went and bought a home, I was like, okay, you guys handle all that stuff, right? So I know me being type A, I got to build a spreadsheet and track all this. But again, if you get good lenders and a good agent who work together seamlessly, you want to see a lender and an agent working together seamlessly, because that means that between us, we're communicating with the attorney and we're obviously getting you I wouldn't say a debrief, but we're giving you status updates on a regular basis. And to make sure that you're not planning your entire life over the next 30 days to move and it doesn't happen. Like, we need to make sure it closes.
Correct. Yeah, having the right team in place is huge.
Let's talk about cash to close. It's a topic that maybe isn't the most favorite for buyers. What are some ways buyers getting that cash to close, whether it be from their own bank account or other creative ways?
So there are a few ways. So first of all, we have access to, I think, 5 different down payment assistance programs. And those can actually cover all of your down payment plus part of the closing costs. And then really the other way that we're seeing people be creative is through the use of seller credits. So when you think about the fact that you're probably financing between 90 and 96.5% of the purchase price, whereas closing costs are always dollar for dollar. And so, for example, if you're using an FHA loan and you need 3.5% down and your closing costs are $8,000, if you raise the purchase price $8,000 to get the seller to cover $8,000, you only need an additional $300 out of your pocket. Whereas if you were to bring in the cash, you'd need not only your down payment of 3.5%, you would also need the $8,000. And so that's probably one of the biggest ways that we help people creatively think about that. Because if you raise the loan amount $8,000, your payment is only $40 to $60 more. And most people can afford the $40 to $60 versus the $8,000 in cash out of their pocket.
Exactly.
So it's just a creative way to think about the same amount of dollars that have to come from somebody.
That's a good example of how a lender and an agent will work together, because the lender's going to know the financial situation of the buyer a little bit better than the agent. Obviously, the agent needs to know where they are. But when the lender works with the agent, because the reason I say this is because the agent's going to be the one to write the contract to negotiate in the increase in price point for the home if we want to get those seller credits at closing. Also, we may just even negotiate in seller cushions without increasing the price of the home. So there are different ways of doing it, but that definitely is a good one so that it doesn't have to come out of your pocket. And that's not a guarantee for every home. It really is up to the seller if they're going to do that, and how the buyer agent and the seller agent work together to accomplish that, to get this to closing. Anything else you want to add there?
No, I think that it goes back to thinking about who you work with matters. And we've touched on it once or twice, but like having the right team in place and how your lender partner and your agent work together seamlessly to help win for you.
So what are you seeing as a typical closing time, and what are you seeing as a quick closing time, and how do you accomplish that?
So a typical closing time is about 30 days. By the time we've gotten the contract, done our disclosures, gone through underwriting, got title work, appraisal, all the fun stuff, that the steps involved in the loan process, it's typically about 30 days. When we need to, though, we can close in as little as 10 days. But in order to do that, everyone's got to be rowing in the same direction, meaning the title work has to be, the attorney's got to be on board with it, the insurance agent, the client, and both agents have to be ready, willing, and able to jump as fast as they can and as hard as they can and as high as they can, as quick as they can.
Because
There's no room for error in a 10-day closing.
and everything is, not everything, but there's so many surprises that you can't plan for.
Correct.
We could have spreadsheets and lesson learned scenarios all day, but there's always something new that pops up.
Correct.
So here's a pitfall I've run into multiple times with condos specifically. Is there litigation? Do they have reserves? How clean is their HOA, bylaws, and things like that? So how do you navigate those situations from the lending side?
That's a really good question, because I'll start with condos can be tough to lend on in general. It seems as if a lot of the times they start out with the best of intentions and then things go awry and they're always playing catch up. So the way that we bridge that gap in the condo world specifically is we start on them as early as humanly possible. We get all the HOA contact information up front, and we always order all of our questionnaires on a rush, along with all the supporting docs right up front. We also have a fantastic condo team that will dive in and get any holes filled in that the HOA didn't answer. And then if we have to, we can switch gears because we have several different non-warrantable condo investors, meaning if it doesn't fit like the traditional definition, like it doesn't have enough reserves or the insurance coverage doesn't work, we have outlets and options for sending those clients through too. The other option is if we have a minimal down buyer, say a 5% down owner occupied buyer, and they have the cash to be able to go to 10%. At 10% down, you get into a limited review, which means we're getting into less of those landmine questions that could potentially throw a condo out of being lendable. And so there are a few ways to dance around some of the issues there that can simplify that process. But in general, condos are tougher than planned unit development and single families.
Thank you. That's good stuff. So the more you put down, the less red tape there is for all the things that a lender wants to look at or needs to look at to approve a loan for a condominium.
Correct.
That's cool.
Yeah, technically. Fannie Mae says there's only 4 questions you need to ask if you put 10% down or more. Yeah, there's no one out there that follows that to the letter of the law, but if you really needed to beat somebody over the head with a hammer, there it is.
Okay, so if you're a veteran or a current service military member, you have the VA loan at your disposal. Now, Derek, can you talk about how someone who's qualified for the VA loan would go about starting that process? And then quickly after that, maybe add in, if someone uses it 2, 3, 4, 5 times, how does that induct them?
2 really good kind of thoughts. The VA loan is actually like the greatest tool in a veteran's tool belt for purchasing multiple homes at different points in time. And what I mean by that is, so the VA changed their rules a couple years ago that technically they say it's unlimited that you can purchase a home for with 0 down payment. And there's no mortgage insurance. They do have a funding fee, which, unless you're exempt, is built into your loan amount, and it goes up in percentage with the more uses. That's with nothing down, and it taps out at 3.3%. But if you put something like 5% down, it's only 1.5%. Now, the VA technically says it's unlimited as far as how much you can finance with nothing down. Most lenders, though, cut it off at around $4 million if it's your only VA loan. When you get into multiple VA loans, you have this calculation based on your entitlement, which is a percentage of the maximum for the county you're in. We don't have to get into the weeds on that, but you can purchase multiple homes up to, currently it's 766 with nothing down, $766,000. You can have multiple VA loans with nothing down. Probably going to be moving to about 806 after January. Again, that's multiple VA loans with nothing down. Beyond that, you need some percentage down based on the calculation that, again, don't have to get too deep into the weeds too, but it's a really great wealth building tool because as prices in general rise, you build enough equity to eventually convert that loan to conventional with no mortgage insurance, which then frees up your VA entitlement to go back and rinse and repeat and rinse and repeat and rinse and repeat. I mean, I have a few veteran clients of mine that have purchased, I think, 7 different homes, all using VA, converted each one of them to conventional, and
There's the hack.
onward and upward. So
That's awesome. Thank you. Okay, so let's talk about PMI. PMI is something that buyers cannot stand, they dread, they want to figure out ways to get around it.
Yep.
So talk a little bit about PMI. What is it? What does it mean? And what's the best way to handle that?
So PMI stands for Private Mortgage Insurance. And what it's there for is to protect the lender in the event of that the buyer stops making their payment, to protect the lender's equity position in the property, just like car insurance. So if you crash your car, the car insurance company is going to pay off your car and give you any small amount of overage. It's the same thing in the lending world. So if you stop making your payments, they're going to pay us to make sure that we're made whole in the event that we have to take that property back. So their little name kind of fact that most people don't talk about, there's 4 ways to do mortgage insurance. There's the traditional, you pay a monthly, which if you have good credit and even as little as 5% down, that PMI payment is pretty low, relatively speaking.
If you have 5% down
And good credit, meaning like over 740, that PMI payment is very negligible in the grand scheme of things. It's typically less than 0.5% annually. So when you break that down monthly, it's pretty low because you add it to your interest rate and you still have what's called a blended rate that's pretty good. So option 1 is you pay a monthly. Option 2 is you pay a single charge, so then you never pay it again monthly. Option 3 is a variation on that. It's a single charge, but you build it into your loan amount, so it's not cash out of pocket. And option 4 is the lender can pay the mortgage insurance. They just raise the rate and they cover the mortgage insurance for the client.
Okay.
So anytime you put less than 20% down, there's going to be an element of mortgage insurance. Even when they say no PMI, they're just raising the rate to cover it.
So what is the clear marker for a buyer to know if they have to deal with and pay PMI or not?
Anything less than 20% down is going to require mortgage insurance in some form or fashion. Now, the government loans, the FHA loans specifically, has their own version of it. It's called MIP, Mortgage Insurance Premium. And unless you put 10% down, it's with it for the life of the loan.
Oh, wow. Yep. That's for FHA.
FHA.
Okay. That's good stuff.
If you really break it down, it doesn't add so much to your monthly cost that it should prohibit somebody from purchasing a home. Really, at the end of the day, it's, again, good credit, minimal down. I mean, I've seen it as low as 0.3% a year. So if you were able to get a 6.75 rate today, which is pretty good for today, and you add 0.3 to it, you're still at 7.05. It's really not bad.
Okay. For $1 million home, for instance, what is PMI extra a month?
I'm going to do some math in my head real quick.
Yeah.
So probably between $200 and $300 a month.
Okay. Yeah. But I get it. It is, because $1 million home is what?
So
Yeah, a couple $100 at that range is really not that bad.
correct.
Okay. Huh. New builds. So for new builds, that every time you go into a model home and you talk to the staff there, they're always going to offer a preferred lender, a preferred attorney, and typically the preferred lender is going to have amazing interest rates or $10,000 off of closing or some sort of incentive like that. What would you say to a buyer who obviously wants a good deal, wants to get free money, and wants a good rate? What would you say that they do in those cases where this seems so obvious that they should go with the preferred lender?
That's simple. We actually had an example of that. And at the end of the day, it worked out where it made sense to take the free money because of the time horizon. So what you have to do is you just have to compare. You've got to look at how long am I going to be in the house? What's my ultimate goal for the house? And how much money are they giving me in either the form of interest rate or seller concessions to offset my cash to close? And then you just make an educated decision. And as long as you're armed with the facts of this is what this costs, this is what this costs, this is what this costs, and you can make an informed decision, then you did the right thing. But if you just go with what they say, then you're operating a little bit in blind faith and hoping that you're getting the best thing available for you.
And hoping that all those resources in one huddle under the same roof, speaking the same language, have your best interests in mind rather than stepping outside of that bubble and checking with a third party who has nothing to do with the bill at all. And like Derek just said, there's many instances where he'll recommend that you go with the free money, where you go with the preferred lender. So there's never a pressure situation. It's more of a quick educational, hey, we want to have a conversation, ask what your situation is, what's the new builder, what's the preferred lender offering you, and here's what I can do. And let's look at them side by side. And we both want you to go with what's best for you. So if it works out to where you need that cash up front because that's your situation, and paying a little bit more in the long run is what you'll accept, then so be it. We want to, I think, to inform you more than anything else, right?
Correct. You made an interesting comment there about a conversation. So all of this, everything that we do stems from conversations.
That's it.
Because once you've learned about somebody, you can learn how to help them. And at the end of the day, that's what buying a home is. It's helping somebody achieve the goal of homeownership. And the lending is a complementary process in that either makes the experience better or worse.
I think so many people are worried about how this process starts. You literally could text us or call us and we could put together a plan in a side-by-side 5-minute conversation.
Correct. Yep.
It's that easy. We're just having a conversation with you,
Yeah.
telling you what your options are to save you money and to help you with a massively important piece of your life, buying a home. It's super simple to get started.